We saw the president last night talk about an economic miracle. Frame GDP right now and how miracle-y, I'm trying to do Jefferson Starship from another time. How miracle-y is our economic miracle?
Miracle might be a strong term to be using. We had an extremely solid year.
This was
and we're heading into what's likely to be a more moderate growth year. Pretty much everything points to a somewhat of a slowdown. The question is how much, to what degree. And part of that depends not on the U.S., but on the global economy. How much does China slow down? How much does Europe stabilize? So we're really all in this together.
Yeah, what U.S. Bank does great is the micro details. I see auto sales. I see the Tesla price cut that Viviana mentioned earlier. There's auto inventory. Boy, it feels like the 70s. Are we slowing down, Eric?
We are, Tom. Yeah, we absolutely are. We look at about 700 different data points, globally speaking, and really the trend is negative. I wouldn't say sharply negative, but to Julia's point, it is a slowdown. So it's not just a European thing or a Chinese thing. It is actually a U.S. thing as well. So at the margin, the data is coming in a bit weaker, which is modestly concerning.
Eric, does that mean that you don't trust the rally that we've had in risk assets so far this year?
We don't really trust it that much. We think that the key level right now in S&P is 2,800. Not to say that we're markedly bearish by any stretch, but this is an environment where we've come off of almost that elevator down and stair step back type of motif, if you will, where we saw that sharp drop of as Tom referenced earlier, on really crescendoing on the 26th of December. And since then, it has been a very gradual migration higher across most risk assets, but certainly U.S. assets have been quite strong. So we're still somewhat cautious here, really maintaining more of a balanced outlook as opposed to more of a risk-on, pro-growth outlook that we adopted in 2017 and early 2018.
Yeah, and part of that, Eric, is working out where the Fed goes from here after the pause. Julia, I've had, a number of people say to me that we could just get one more hike from the Fed. Others say, no, it's done with the hiking cycle. Does it actually make much difference whether we get no hikes or one hike in 2019?
It doesn't make a difference. I mean, I think what we're hearing from the Fed is that they have a neutral policy stance. They don't even have a hiking bias at the moment because of all of the headwinds that they're seeing out there. So if we get a hike, it will be because the economy is performing a little bit better than expected. And they've pretty much laid that down as a marker. We need to see stronger growth than people are expecting right now, maybe a little bit more inflationary pressures in that environment. And I think in that situation, we'd be seeing more of a risk-on type of moment in markets or mood in markets. And I agree that this is more what we're seeing in markets right now is sort of a relief that central bankers aren't going to kill us.
Okay, I want to do this. This is too good. With Eric Freedman and Julia Coronado with us, we're going to go all options with you. Good morning, Sheldon Natenberg. You got a put, the Powell put, where you put something under the bottom. You got a call where you're believing up. And then you have a collar where you construct a trade that goes both ways. From now on, it's a Coronado collar. What do you mean by the Coronado collar?
Well, we've seen that the Fed and the Powell Fed is very clear about this. They're calibrating off of financial conditions. So when they were seeing financial conditions get a little bit frothy, they were a little worried about that, and all else equal, that made them more inclined to tighten policy. So if we saw markets come roaring back and get back to sort of valuations that can't really be justified by economic fundamentals, which I think that's where we were in the equity markets, then all else equal, you should tighten
But I got a major problem here.